So chapter 12 is really all about the statement of cash flows, which is a really important financial statement to understand. And we're going to start, of course, with learning objective 1. So let's do this. The cash flow statement is strictly about cash. Okay. And what we mean by cash flow is cash coming into the company and cash going out of the company. Okay. It can be simplified like that. That's a good way to start understanding it. But it provides a lot of information. You know, what is the company's ability to generate cash flow? Most of the cash the company should be getting is from selling its goods and services. They're selling it for cash. So most of the cash flow generated at a company should be coming from selling their stuff. But of course, there are other ways in which companies can get cash. They can ask investors for cash when they sell common stock. They can also borrow cash from banks and other entities as well. So we'll be looking at that. But again, most of it is going to come from how well are they able to sell their goods and services. Another thing that the statement of cash flow allows us to look at is the issue of cash dividends. Are they able to pay them? Do they have enough cash flow to help pay them? We're going to be looking at some differences between what we consider net income, right, which is the net profit or the profit during a period of time, and how that differs from something called net cash provided by operating activities. This is going to be one of the key things to learn in this chapter, is that piece there. And of course, investing and financing transactions, which I mentioned, are listed in the cash flow statement very specifically. Okay. So cash flow statement looks at three major activities. The first they look at is the operating activity. And again, operating activities overwhelmingly revolve around the income statement. Selling your goods and services to customers is revenue. That's an income statement. Paying most of your bills, whether it's rent or employees or other types of things, you need cash to do that. That's an income statement item. And so operating activities revolve very heavily around the income statement items, as you'll see. Remember, investing activities, we have to go way back to chapter 1. Whew, I'm jog your memory here. Okay. To remember investing activities, we're really talking about mostly property, plant, and equipment is really where most of that should happen. But basically, any long-term asset, including long-term investments, can be considered part of investing activities. So whatever changes are happening there, and of course, this is a balance sheet item. Investing activities tend to be balance sheet related, asset related. Financing activities revolve around the other side of the balance sheet. Where are they getting money? Remember, financing, where are you getting money? How are you raising your cash? Overwhelmingly, you're either borrowing money or owners are putting more money in. So finance activities look at changes in liabilities and stockholders' equity for that. So cash flow, again, looking at cash in and cash out. There's only two ways cash can flow. That's the good news, in and out. How do we look at that from an operating activity perspective? Well, let's just take a look at cash coming in. The inflows in operating tend to be revolving around income statement items. So cash comes in when you sell goods or services. That's your revenue, right? You want to collect that in cash as much as possible. You may also be collecting cash when you receive any interest and dividends that, whether it's from your bank account, they're giving you cash, or whether it's from investments, and you're getting cash from that. So that might be interest in dividend revenue, which is why it's part of this. Excuse me. In terms of cash going out, cash outflow when it looks at operating activities, what are we looking? What do we use cash for that end up becoming expenses on our income statement? Well, first we usually purchase supplies or inventory. Sometimes we pay cash for that. Sometimes we do it on account, but in essence, we need cash to pay those payables. So in essence, we will be paying for inventory. We're going to be paying for wages. Inventory ends up as a cost of goods sold expense, yes? We're going to be using cash to pay our employees for wages. That's going to end up being wages and salary expense. We're going to use cash to pay the government for various taxes that we owe. That's going to be an income tax expense or other type of tax expense. We probably need cash to pay interest on any loans we have. That's going to be part of our interest expense after we're done with that. And any other expense that we need to pay cash for is going to come out of that. So all of these are considered part of operating activities under the cash flow statement. Investing activities under the cash flow statement, any changes in long-term assets and investments are going to be considered investing activities. Most of the investing activities that you're aware of are the outflows. So I'm going to start with the outflows. Cash going out to purchase property, plant, and equipment, to purchase investments, whether it's in debt or stock of other companies. And you can also use cash to make loans. You might have a long-term receivable for that. So those would be considered outflows. And that's what we prefer to see. We prefer to see a lot more outflows than inflows for investing. But when you do see an inflow, sometimes that's because you sold property, plant, and equipment. Not always something you want to see. Depends on the reasons. When you sell off any investments you might have debt investments or stock investments that you sold, and cash was coming in for that. That's an inflow. You might also be collecting loans that you made, and that would also be an investing activity, okay? Because when you made the loan, you made it as an investment. So when you collect it, you're collecting it as an investment. So that's why it is a investing activity here. Financing activities here revolve around any changes in liabilities and stockholders' equity. And again, we're looking at cash flowing in or out. So how does cash flow in from an investing activity? Well, when you sell common stock to stockholders, cash is coming in. Also, if you issue bonds or issue notes, cash is coming in. So these would be cash inflows from financing activities. In terms of outflows, cash being used, sent out of the company, well, that's when you pay dividends. You're sending cash out of the company to stockholders. So it affects stockholders, which makes it a financing activity. Okay. Also, when you pay off any long-term debt, or if you buy any treasury stock, that's money going out, but for a financing activity. Okay. And so these are very important types of things to sort of understand when it comes to identifying it. Not everything revolves around cash. Believe it or not, there are some very important, extremely important non-cash activities that happen in companies. In other words, that don't involve cash. One of the activities is buying assets by issuing stock. So buying assets for common stock. Okay, that doesn't involve cash. You're simply paying for the asset with shares of common stock. Okay. So that doesn't involve cash. That would be a significant activity because you're adding to your assets, but you don't need cash to do it. Another is when bonds are converted into common stock. Remember, we have convertible bonds where the bondholder can decide at some point to change or exchange, rather, their bond into shares of stock in the company. So when that conversion happens, it doesn't cost any cash. They're simply exchanging the bond for shares of common stock. That's it. So that's also a very significant non-cash activity because you have less liabilities when bondholders do this. You don't have to pay them back because you've already paid them with shares of common stock. If you buy an asset strictly through the issuance of debt, you simply borrow to buy the asset. That's also a non-cash activity. It's not costing your company any cash. You simply purchase the asset with a loan, but technically nothing is flowing in or out. Okay. Or if you exchange an asset, so you have a delivery truck and you exchange it for a new delivery truck. Okay. Doesn't necessarily need to cost you any cash. That would be a significant non-cash activity. Because they're non-cash activities, they're not reported on the statement of cash flow, but companies still must report them. They must tell their owners that these activities happen. Where do they report them? Well, they either do it on a separate statement, or they add the notes to the financial statements about their non-cash activities. So this is one of the things you're going to be learning in the next objective, is net income is not the same as cash that's provided by the operating activities of a business. And learning objective 2, which we'll get to next time, really pushes this, in detail. So first of all, net income is simply net profit, right? Net profit should be what most people look at. Net profit is everything that's left over from the revenue after paying all your expenses, and so that should be cash. No, it's actually not the same as net cash, and you're going to see why very shortly. Here's some examples of companies that show their net income and the net cash that's been provided by the operating activities. Now, since most operating activities revolve around the income statement, you might ask, why aren't they the same? That's what you're going to learn in objective 2. But as you see, they're not the same. Because whether you have Kohl's Corporation here, and I don't know what year this is, but they reported an $889 million profit for net income on their income statement. However, they had cash provided by the operating activities of $1.8 billion, much more than just the net income. Same thing with Walmart, showing a $16 billion net income, but they had over $25 billion in cash provided by their operating activities. So you're going to learn about these differences in learning objective 2 next week. It's very important to understand we will be putting together statements of cash flows. That's a big thing that you need to know. It's the only financial statement we haven't really looked at in any detail until now. So you will be doing this, and just like the other statements, they take a little bit of time to get used to. We're going to be learning very specifically the indirect method of doing operating activities. But in essence, the statement of cash flow has an order that's listed. It's going to start with operating activities. It always starts with operating activities. And it shows net. Usually there's going to be cash provided by operating activities. In other words, there's going to be a cash flow coming into the company from its operating activities. Then it'll show a separate section with its investing activities. Now, normally you want companies to be investing. You want them to be purchasing assets that are going to help grow the business, right? Make the business larger in terms of its sales, revenue, and profitability. So normally investing activities take cash out of the company, right? And so you'll see how investing activities oftentimes uses cash, takes cash out. The difference is often sort of balanced with the financing activities. Sometimes the investing activities are so great that there's simply not enough cash from operating activities to take care of everything. So they might need to go ahead and either borrow money or issue more stock, shares of stock, and raise cash that way. So finance activities can go usually both ways. Sometimes there's positive cash flow, so there's cash coming in. Sometimes there's negative cash flow, which simply means there's more cash going out. So you will see this order on all these statements, and you'll be doing them next week. Woohoo! This is what a statement looks like in general, and it sort of goes through that order that we just looked at. So it'll have a very formal title, like most financial statements do, the name of the company, the name of the statement, and the period. Now notice that the cash flow statement covers a period of time, very much like the income statement or retained earnings statement cover a period of time. Except the cash flow statement is not subject to periodicity. Okay. And that's because the cash flow statement tells us about the cash, which in essence ends up on the balance sheet. Right. So this is just a story of cash flowing in and out of the company. All right. So again, like we mentioned, the very first thing that's always listed is the cash flow from operating activities. We're going to be looking at a very exhaustive list of that next class. I just wanted to prepare you today and get you familiar with the statement a bit, because we're going to be diving deep when I see you on Tuesday. It's going to be a pretty good amount of homework next week. So normally when you list the items for operating activities, in many instances, if there's more cash coming in than being used, they use the phrase net cash provided. So net cash provided simply means there's cash flow coming in. If there's cash flow going out, in other words, more is going out than coming in, they'll use the word used, net cash used. So provided simply is more cash coming in than out. Used simply means more cash going out than in, specific for each activity. Okay. So like I said, in most cases, net cash will be provided. So this will be a positive. You'll see this number here normally as a positive number. And positive numbers on cash flow statements simply means cash coming in, more cash coming in and going out. The next section, as you remember, is the investing activity. Now, for investing activities, like I said, you want the company to be buying long-term assets because you want the company to be committed to growing more sales revenue, more profitability. So oftentimes what you'll see in this list of individual investing activities, you'll see more money usually going out than going in. And that's okay. That's a good thing, right? And so what you'll see is there's going to be net cash used by investing activities. This number will come up in parentheses looking like it's negative. It's not negative. It simply means that this is cash going out of the company being used for investing activities. So the positive, negative thing on a cash flow statement simply means whether there's more coming in or more going out. Positive means there's more coming in. Negative simply means there's more cash flowing out. That's it. So it's not real positive and negative like you would look at on a calculator. It's just simply what's coming in, what's going out. Those views. And again, we do it for each individual activity. Operating activities, like I said, normally we'll have a positive number here showing cash coming in. Investing activities, normally we use more cash. So this is often going to be negative going out. The third part is the financing activities. Again, this can go either way. So the list of financing activities might be, they might have issued stock, they might have issued bonds. So if they have to sell stock or sell bonds, that's more cash coming in because that raises cash for the company. But every time they pay debt down, that uses cash. Every time they pay dividends out, that uses cash. So financing activities are going to go either way. Sometimes it'll be provided, which means there'll be a positive cash flow. Sometimes it'll be negative, simply means there's more flow going out than coming in. So this number is going to go either way. Okay. When you add these three numbers up, you're going to get a difference that's listed here as either an increase or decrease in cash for that period of time. So either you have more cash or less cash, an increase or decrease in the cash, based on just simply adding these three numbers together. Okay. That increase or decrease is simply added to the beginning balance of cash, and the difference is going to be the ending balance in cash. So the ending balance in cash simply is the beginning balance compared with the increase or decrease that's calculated. The difference will be the cash at the end of the period. That's normally what's on a cash flow statement. Cash flow statements will also have either a note added to it. Sometimes they do, sometimes they don't. But they will list any non-cash activities. Now, non-cash activities tend to be revolving around investing or finance activities, not operating activities. So again, buying a building for stock. So they bought a building, but they bought it using shares of stock, no cash involved. So you have more buildings, but you also use, you need a treasury stock. So you're going to see some of those differences pop up here, okay? And again, this is all new stuff for most of you, or maybe even all of you. So I am going to be giving you a decent amount of homework on this over the weekend, just to get you used to how the cash flow statement works and what all these things mean, how to think of them, before we actually do a cash flow statement, which is what objective 2 is about. I don't want to throw too much at you all at once, since we are doing pretty well in our time. Okay. So here they want you to classify the transaction as what type of cash flow activity. Again, there's only 3, right? Operating activities, investing activities, financing activities. Operating activities tend to be around the income statement accounts, not solely, but mostly. 2, the investing activities tend to affect assets, long-term assets, property, plant, equipment. Financing activities tend to affect liabilities and stockholders' equity. Okay? So if you can identify all of that, these will make some sense. So here they issued shares of stock. So shares of stock is a financing activity because it affects stockholders' equity. finance activities affect stockholders' equity. So that's why it's that. Here, we borrowed money from a bank. So borrowing money from a bank is a long-term loan. That's a financing activity as well, because it's a long-term liability. The third thing here is we purchased semi-trailer trucks. So two of them. Semi-trailer trucks would be property, plant, and equipment for a company. That's a long-term asset. That's why it's an investing activity. The fourth thing here is we paid employees for salaries and wages. Salaries and wages is an expense. Expenses are part of the income statement. It's an operating activity. The last thing here is we collected $20,000 cash for performing services. Performing services is a revenue account. Revenues are on the income statement. It's an operating activity. Okay. So that's the introduction to this cash flow statement. Learning how to identify all these things is really going to help you understand the next part. So I will be loading you up on some good work this weekend on this topic. But we're going to do one step at a time because we can. I think it'll be helpful to do it one step at a time. Sounds good?